Have you ever entered a trade, watched it move in your profit direction for a brief second, only for it to immediately reverse, hit your stop loss, and then shoot directly to your profit target without you? It feels incredibly painful. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. In those moments, it literally feels like there is a camera in your bedroom, or like the market is personally watching your account, waiting for you to click buy so it can take your money. You feel angry, confused, and start to believe that trading is just a rigged game. But the truth is, the market is not targeting you personally. The real reason you keep getting stopped out is that you are falling for the exact same traps that millions of other retail traders fall for every single day. You are chasing trends blindly, buying at the absolute top of a move, and placing your stop losses in the worst possible areas because you don't know how to read the true structure of the market. In this masterclass, we are going to change that. I am going to show you a highly simple, step-by-step system to read the market's direction with crystal clarity. We will skip the complicated math and the confusing academic jargon. Instead, I will teach you how to identify real trend movements, how to separate market noise from real structural breaks, and how to spot when a trend is actually turning against you. If you want to stop guessing and start trading with confidence, hit the like button, subscribe to the channel, and let's dive in. Part 1. The twin movements, push and rest, impulse and correction. To read any chart, you must understand that the market never moves in a straight line. It is mathematically impossible. Instead, the market always moves in a rhythmic sequence of 2 distinct types of movements. We call them the push and the rest. In professional terms, these are known as impulsive and corrective moves. Understanding the relationship between these 2 moves is the absolute key to identifying the real trend direction. Think of the market like a professional runner. A runner cannot sprint forever without stopping. They must occasionally slow down, catch their breath, and rest before they can sprint again. In a healthy uptrend, the push is when the price sprints upward aggressively. This push is characterized by large, healthy candles that are mostly of the same color, showing strong buyer commitment. The price travels a great distance in a very short amount of time. After the sprint, the market must rest. This resting phase is what we call a pullback or a correction. During the rest, the price moves backwards slowly. This phase is characterized by small, messy candles of mixed colors, frequently changing from green to red. The wicks are choppy, and the price travels a very small distance over a long period. Many beginners mistake this temporary rest for a trend reversal and panic sell, which is a massive mistake. Part 2. The 38% rule, separating real pullbacks from noise. But here's where most beginners get highly confused. How do you know if a pullback is a real, healthy rest, or if it is just meaningless market noise? If the pullback is too shallow, it means there is no real rest behind it, which makes the market highly unpredictable and prone to false signals. To solve this problem, we use a highly mechanical tool, the Fibonacci retracement tool, and we apply what we call the 38% rule. The Fibonacci tool helps us measure the depth of the market's rest. Here is how you use it. When the market completes a strong upward push, you select your Fibonacci tool. You click at the absolute start of that push and drag it up to the absolute top of the push. This tool will display several percentage lines on your screen. The most critical line we care about is the 38.2% level. For a pullback to be considered a valid rest, the price must drop down and touch at least the 38.2% level. If the price reaches this level or goes deeper, it proves that the market has rested sufficiently, validating the structure. However, if the price pulls back only slightly, say to the 23% level, and then continues higher, we do not count that as a valid pullback. It is just internal noise. By waiting for the 38% rule to be met, you protect yourself from entering trades on weak, shallow pullbacks. Part 3. Identifying the true turning points, swing highs, and lows. Now that you know how to identify valid pushes and rests, step number 3 is identifying the true turning points of the market. In trading, we call these swing highs and swing lows. These are the extreme peaks and valleys of the market structure. Understanding how to locate them is critical because breaking these levels is what signals a trend continuation or a potential trend reversal. Let's look at an uptrend. An uptrend is confirmed when the price is making higher highs and higher lows. But how do we define a valid swing low? A swing low is the lowest point of a pullback, but it is only confirmed after the price successfully pushes up and breaks above the previous swing high. If the price does not break the previous high, that low is not confirmed yet. It is still just a developing move. This distinction is highly important. Many new traders mark every single little dip as a swing low. They think that if the price drops below any minor dip, the trend has reversed. This leads to massive confusion because they end up trading counter-trend on minor fluctuations. Remember this golden rule: a swing low is only validated when the market structure is broken to the upside. If that structure is not broken, the previous trend is still fully intact, and you must maintain your bullish bias. Part 4. The Breakout Trap: Wicks versus Body Closes. Now, let's discuss how we confirm a true trend continuation. In trading, we call this the break of structure, BOS. A break of structure happens when the price breaks through a previous swing high in an uptrend, or a previous swing low in a downtrend. But here is the major trap where beginners get stopped out: wicks versus body closes. Many traders see a candlestick wick shoot above a previous high and they immediately buy, thinking a breakout has occurred. This is a classic breakout trap. A candlestick wick is like a shadow. It shows you where the price went temporarily, but it doesn't show you where the price settled. A wick above a key level often represents a liquidity grab or a stop hunt. Big institutions will intentionally push the price above the previous high to trigger the stop losses of short sellers and entice greedy buyers, only to immediately reverse the price. For a break of structure to be considered valid, we must wait for a candlestick to clearly break and close with its full body above the previous swing high. A body close proves that buyers have sustained the momentum and are committed to holding the higher prices. If you only see a wick pierce the level and then snap back, you must ignore the breakout and wait. Waiting for the body close is your shield against false breakouts and emotional FOMO entries. Part 5. The Turning of the Tide: Change of Character. What happens when a trend is finally ending? How do we know when the buyers have lost control and the sellers are taking over? We look for a change of character, commonly known as a CHoCH. In an uptrend, our valid swing lows are our lines of defense. As long as the price stays above the most recent confirmed swing low, the uptrend is still healthy, and we only look for buy setups. However, if the price reverses and closes with its full body below our last confirmed swing low, a CHoCH has occurred. This body close below the key support line proves that the buyers have failed to protect their defensive level and the market structure has officially shifted from bullish to bearish. This is your signal to stop looking for buy trades and start preparing for sell opportunities. Let's recap this in a bearish scenario. In a downtrend, we have a series of lower highs and lower lows. Our confirmed swing highs are our lines of defense for the sellers. If the price rallies up and closes with its full body above the most recent confirmed swing high, a bullish CHoCH has occurred. This proves that the sellers are exhausted and buyers have taken control. This simple, non-indicator structure reading is how you stay on the right side of the market. Conclusion and risk management protocol. By learning how to read pushes, rests, swing levels, and structural closes, you can navigate any market condition without relying on messy indicators. But remember, trading is a game of probabilities. Always use a stop loss on every single position. Place your stop loss safely below the confirmed swing low for a buy and above the swing high for a sell. Thank you for watching, stay disciplined, and I will see you in our next masterclass. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.